It's hard to beat the market. Okay, but what is the market? Common advice you get everywhere: don't try to beat the market. Just invest in X. The irony is that X always seems to be something else. In this sub, it's usually the SP 500, but this sub is mostly used by people from the US. If you visit a European investing sub and tell them you are 100 in SPY, they will tell you it's hard to beat the market and it's better to invest in the MSCI World. Then you do that, and next time people will tell you it's hard to beat the market, you better also invest into the MSCIM. Alright, so you throw some emerging markets into the mix. Then you come back here and everybody points out that SPY has, in fact, consistently beat the MSCI World. Okay, you think that's actually true. Maybe you should mix in 50 SPY as a compromise? Only to realize that the Nasdaq 100 in turn has beaten SPY consistently as well. And Apple outperformed the Nasdaq 100. So all in Apple? Because it's hard to beat the market? Nasdaq is rarely used as the market. It's tech-focused. SP 500. Most of my holdings are VTI. Most of my gains are AAPL. Coin. Meta. Because yes, I timed the market and bought when everyone was super soured on them, especially Coin $40. Meta $100. VU. VTI is the US market. VT is the world marker. S historically outperforms the rest of the world. Nice try, Warren Buffett. To me, the market is the total of all available stocks, equal weighted, which is VT. The idea that you can't time the market is a myth. Usually they mean a particular stock versus a broad fund. Often market performance is dominated by a small percentage of stocks, so a broad fund is less likely to miss them. Like if you picked 10 stocks at random from the SP each year, it'd usually underperform because maybe you didn't have NVDA or MSFT this year, who are buoying the whole index. Also, it's not that hard to beat the market. Not every year, but overall. Just be underweight in habitual underperforming sectors like utilities and you'll likely be at the market. You'll likely have a higher beta since utilities is fairly stable, but returns should average a bit higher. I will never invest in X. MSCI World for all and/or their country's specific main index if that country is developed enough to have a sophisticated stock market. Simple as that. I don't know what this post is actually asking, though. To me it looks like nothing more than complaining that different people on Reddit use different broad index funds. No shit, Sherlock. What people seem to forget is that it is not that difficult to beat the market SP 500. You can have a few good stock picks and do fairly well. The key is having a better risk-adjusted return than the market. This is also referred to as having a positive alpha. Most cannot beat the market is why low-fee SP index funds are the way to go for most. The market is usually the SP 500. Invest in individual stocks to beat the market. The US has the best landscape for public companies, but it is correct that US international outperformance goes in cycles, and we very well may be completing a cycle of US outperformance and entering one of international outperformance. Nonetheless, the US has significantly outperformed on long-time horizons spanning many cycles and is by far the largest market. About 40% of SP revenues are earned internationally, so the SP is arguably already globally diversified. Easy to beat the market by all of SP, except one company you're betting against. Replace it with one company not in the SP you're betting on. The typical benchmark most people try to beat is the SP 500. As a money manager, it's up to you to pick what benchmark you want to compare yourself to. There will be different tax implications and incentives depending on your citizenship. Honestly, it depends on the scale you're talking about, but generally the world market cap. Locally, just the US. It's VU or VTI. I think it's generally safe to say it's hard to beat a broad market cap passive approach consistently without leverage or extensive idiosyncratic risk. By market, you generally take the SP 500. Regardless of the country of your origin, the US market is highly liquid because all the world invests in it. The narrower you make your case Nasdaq or a single stock, the more volatility and risk you're taking. More volatility and risk can bring bigger gains and bigger losses. I am European and the market is the SP 500. For a matter of fact, I am mainly invested in the SP 500 because of this. If someone tells you that that leaves you in a position of too much exposure, then maybe you can tell them that if the US economy is tanking, then the world will be tanking. The market is based on what country you're from. If you're from China, anyone can beat the market. Just stay out of it. Yes. The mysteriously unspecific 7-Eleven returning index fund. Let me know when you find it. I will put all my money there. Forget the market. What is your target rate of return? What do you need to meet your goals? That is all that matters. It's the no balls sub. It's the place where everyone invests in index funds, and even stock picking is too risky for them. The market is the American market SP. If you're looking at your retirement account allocations, international non-US holdings are classified as risky. There isn't much upside to those risks either because they almost always have lower returns than the SP. United States commerce has the least regulations and consumer protections of all the major capitalist economies. So it's much easier to profit in the US. Just take a look at the troubles that major tech companies like Google, Meta, Apple, etc. have in Europe. They are always getting fined for anti-consumer practices. Fair question. I would also name MSCI World or SP 500. I believe the sector diversification and then having 100 companies in them make them diversified enough to call them the market. Warren Buffett even times the market as in buying when opportunities present themselves. Meta is a great example. Back-to-back World War champs. I mean, it feels like if you invest in just one stock it will go up and down quickly. And if you invested in every stock it would go up slowly. But probably go up over time as life on Earth slowly gets better. For everything it seems like you are picking the volatility that is likely to pay off in your own human lifetime. Owning a perfect portfolio of every stock that exists would probably make you richer in the next 500 years as emerging markets emerge. But if you plan to retire in 50 years, you have to cut that down narrower to just the market already developed enough to be something in half a century. How about a based on historical returns over the last 30 years? And you can use every single ticker you've mentioned. The market is other investors smarter, riskier, wealthier than you. VT or VTI are good benchmarks. VT total global stock market, VTI total US stock market. SP 500. It really hasn't been hard to beat the market for like 15 years. All you had to was buy Amazon or Apple. Or buy oil when it was like $5. Seems like some kind of religion to repeat the same phrases. The other funny one is time in market beats timing the market. How many people have thrown in a massive lump sum and regretted it because of that dogma? The market is the collective sentiment of investors. I think I beat the market, my portfolio up 9.34 in the last year. This is a myth. 2023 is a good example that it is not hard to beat the market. VT is the market.